We recorded a video a few days taking a closer look at ChargePoint Holdings and highlighted some real serious concerns we had with the company. Now, we dropped that video on our YouTube channel on November 16th. Today, November 17th, the stock is absolutely crashing. I can tell you that our analysis did not have anything at all to do with why the company's stock is dropping today. As a matter of fact, there is far worse news coming out of ChargePoint that has investors concerned. Again, the stock is falling today. It's down a ton over the past year, not just today's drop. I'm Jason Hall. This is The Smattering. We're going to talk about what's going on with ChargePoint, why the news just got a whole lot worse, and what investors should be doing right now. But first, this video is sponsored by The Motley Fool. If you're looking for actual great stock ideas, go to our special link. Go to fool.com/The Smattering. The Motley Fool is going to give you its 10 best stocks to buy right now. You probably want to check that out after watching this video. Okay, what's going on over at ChargePoint right now? Again, we talked about the stock absolutely taking a bath today, down 35% today. If you look at it from the beginning of the year, down 80% almost, and from the highs, it's down 85%. It has not been a great day at all. All right, so what's happening? So this is what we got yesterday, November 16th, after the market closed. ChargePoint dropped a couple of press releases. Here is the first one. Preliminary third quarter financial results, scheduled its earnings call for December 6th, to about 3 weeks away. What did ChargePoint say that has the market so rattled? First thing, revenue results. Initially, we're guiding for $150 to $165 million in revenue. They gutted that. They said it's actually looking like our revenue number is going to come in between 108 and 113 million. Call it $111 million at the midpoint of guidance. That's way, way down. On top of that, they've taken a $42 million non-cash impairment charge. It's never great when companies are starting to take impairment charges as they're having trouble with their revenue. Now, they highlighted a couple things they're trying to say were pretty good. Like they're saying our gross margins revenue is way down, but our adjusted gross margin pre-impairment is still pretty close to what our goal was. But again, that's ignoring the impairment. They're also saying that our operating expenses, they're within shouting distance of where we set. So trying to highlight some good things. They're also saying as of October 31st, we've got more money than we had. We raised the money. Raised the money from that at the share program, that capital raise that we talked about. We did raise a little bit of money. All right. So they're trying to take a really bad story, put a little bit of spin on it and say, maybe it's not so bad. I want to point out the previous video that we did that we just dropped last night highlighted that capital raise as being brutally painful for investors. As the result of raising that money, they had to go back to prior institutional investors and sweeten the pot on a deal that they had already done. They did a convertible debt deal sometime in the past year. And with those institutional investors, they went with their hat in hand. In order to get those institutional investors to pony up some more money, they did two things. Number one is they said, we're going to cut the price in half for those previous convertibles to convert. They cut it from $24 to $12 a share. And they said, we're also going to pay you a lot more interest. If we pay interest in cash, we'll basically pay double the amount of interest we agreed to pay before. We got a pay in kind deal that's part of it, which means if we don't have the cash, we'll pay in stock. We're going to pay even more stock instead of interest to serve that debt. So the way they were able to raise that money is by giving a lot more of the company to these institutional investors. So it was a brutal capital raise for shareholders. And now it looks like they absolutely had to do it based on where the numbers are. It tells me management knew the results were not going to be really good. Now this takes us to our other press release. Frankly, this is the one that scares me. I know that's a big word to use. ChargePoint announces executive leadership changes. You know what? Companies issue press release like this all the time. Somebody changes, they get a new chief information officer, chief marketing officer, that kind of stuff. I got some really bad news for you here. ChargePoint's two most important senior executives are leaving. You've got its CEO, its longtime CEO, Pasquale Romano. It's been there since 2011. He's out the door effective yesterday. I'm recording this on the 17th of November. Yesterday was his last door. Boom, out the door, being replaced by somebody that's been at the company for 18 months. You know what? That's not terrible. At least you got somebody, Chief Operating Officer Rick Wilmer. It's been at the company at least for a year and a half. So that's something. Boom, just like that. He's the CEO. Long-term CEO is out. You know who else is out the door? The CFO. Same time as your CEO is leaving, your CFO also out the door. That, my friends, that's really concerning. You have the company that just raised capital. Basically, they were over a barrel. They had to raise capital at unshareholder friendly terms. And now they're saying, you know what, we're going to miss our guidance for quarterly revenue by a huge amount. We're going to take a $40 million impairment charge. It's nothing but bad news right now. Okay. Here's the thing. What makes it really concerning for ChargePoint and ChargePoint investors is this is not a company that's making money. This is a company that is burning through cash, went public, raised a little bit of money, but they continue to absolutely incinerate that cash. Again, we know that this number is closer to $400 million now, that cash and short-term investments, but we know it continues to absolutely incinerate money as it tries to get to scale. And now it's got to do it with a new CEO in place, and it's got to do it with a new CFO in place to try to get the books together. Investors should be very concerned with ChargePoint right now. If you're an investor in the company, what do? That's up to you. But I'll tell you what I would do if I was a ChargePoint shareholder. I would be selling and moving on. I think there's no doubt about it that this is a very risky business. It's incinerating cash. This is not a buy on the dip opportunity because the stock is beaten down for a lot of really bad reasons. Two most important executives out the door. You're burning money. You're raising money at bad terms, and business is getting worse. Okay. What do? If it was me and I really wanted to participate in the upside that's so attractive, the growth of EVs, the electrification of everything, and maybe I wanted to look for a beaten down stock, I would look away from ChargePoint and I would look at Enphase. So again, Enphase and ChargePoint don't exactly compete. Now, Enphase does make EV charging stations, but mostly like to put in people's houses and garages. That's mostly what their target market is. But that makes sense because it fits with their core business, with their solar panel level electronics and their energy storage. Distributed solar is a big business for them. So in people's homes, residential solar. So they're selling charging stations that fit with where they already are. It's a good business. It's a place that they can make profit. And they have been very profitable. Okay. So maybe you're not directly tied to just EVs with Enphase, but you're tied to a business that knows how to make money. I want to highlight some of the differences between Enphase and ChargePoint and talk about how this is a business that knows how to make money. We're just going to start with Enphase right here. So you look at its cash flow metrics. Again, it's no comparison. This is a company that over the past 4 quarters has generated over $800 million in free cash flow, massively operating cash flow business. And it has a ton of money on its balance sheet. And that amount of money has been growing. Compare that to ChargePoint. ChargePoint is incinerating money right now. And its cash stockpile, again, before the debt raise, or before the capital raise that it just did, continues to get smaller and smaller. And my guess is it's going to start shrinking again, even after this capital raise. So you put it all together, you think about the trajectory of these two businesses. The cycle is tough right now. It is not a great time in the renewable energy business. EV business, solars, they're both being affected. The cycle is weak right now. You want to own strong companies during the weak cycle. You don't want to be doubling down on businesses that are weak. You want to invest where there is strength. If you want to profit from the future of renewable energy, the electrification of everything, and you're looking for a beaten down stock, stay away from ChargePoint right now. Take a really close look at Enphase. That might be the best investment you could make. Over the long term, its potential to profit and generate great returns for shareholders is proven, and it's more likely to be that winner again going forward.